Imagine waking up one morning and discovering that the bank holding billions of dollars has suddenly collapsed. Customers rush to withdraw their savings. Investors panic. Markets tremble. News channels broadcast non-stop coverage. Within hours, a financial institution once considered powerful and reliable becomes the center of a global crisis. This is the story of one of the most shocking bank collapses in modern history, the fall of Silicon Valley Bank. For decades, banks have been viewed as symbols of stability. They safeguard money, support businesses, and help economies grow. Most people assume that large banks are built to withstand difficult times. But in March 2023, that assumption was tested when Silicon Valley Bank, often known as SVB, experienced one of the fastest banking collapses ever recorded. Silicon Valley Bank wasn't a household name for everyone, but in the technology world, it was incredibly influential. Founded in 1983, the bank became a favorite among startups, venture capital firms, and technology companies. Some of the world's most innovative businesses trusted SVB with their money. Over the years, the bank grew rapidly, earning a reputation as a financial partner for ambitious entrepreneurs. Everything seemed to be going well. The technology industry was booming. Startups were raising enormous amounts of money. Investors were pouring cash into new companies. As a result, billions of dollars flowed into Silicon Valley Bank. By 2021, the bank was holding more deposits than ever before. But beneath the surface, a dangerous problem was quietly developing. When customers deposit money, banks don't simply store it in vaults. They invest much of it to generate returns. Silicon Valley Bank invested a large portion of its funds in long-term government bonds and other securities considered relatively safe. At the time, this strategy seemed reasonable. The problem was timing. When the bank purchased many of these investments, interest rates were extremely low. But soon, inflation began rising across the economy. To combat inflation, central banks started increasing interest rates at one of the fastest paces seen in decades. As interest rates climbed, the value of older bonds fell. Suddenly, Silicon Valley Bank was sitting on billions of dollars in investments that had significantly declined in market value. At first, this wasn't necessarily a disaster. Banks often hold investments until maturity, allowing them to recover their full value over time. However, another challenge emerged. The technology sector started slowing down. Startups that had once received endless funding now faced a tougher environment. Many companies began spending their cash reserves instead of raising fresh investment. As these businesses withdrew money from their accounts, Silicon Valley Bank faced increasing pressure. The bank now needed cash. To meet withdrawal requests, it was forced to sell some of its investments at substantial losses. That move triggered alarm. On March 8, 2023, Silicon Valley Bank announced that it had sold billions of dollars worth of securities and suffered a major financial loss. At the same time, it revealed plans to raise additional capital. Instead of reassuring investors, the announcement sparked fear. Questions spread rapidly. Was the bank in trouble? Could it survive? Social media accelerated the panic. Venture capitalists, founders, and financial analysts began discussing the situation online. Messages spread at incredible speed. Some influential investors reportedly advised companies to move their money elsewhere. The result was extraordinary. Customers rushed to withdraw funds. But this wasn't a traditional bank run with people standing in long lines outside branches. This was the digital age. With a few clicks, companies could transfer millions of dollars instantly. Within a single day, customers attempted to withdraw tens of billions of dollars. The scale was unprecedented. No bank could easily withstand that kind of pressure. As panic intensified, confidence evaporated. The institution that had spent decades building trust suddenly found itself fighting for survival. By March 10, regulators stepped in. Silicon Valley Bank was shut down. Just like that, one of America's largest banks collapsed. The speed of the downfall shocked financial experts worldwide. A bank managing hundreds of billions of dollars in assets had failed in only a matter of days. News of the collapse spread across global markets. Investors feared the crisis might spread to other banks. Stock prices dropped. Customers at other financial institutions began questioning the safety of their deposits. Governments and regulators moved quickly to contain the damage. Officials announced measures designed to protect depositors and restore confidence in the banking system. Their goal was clear: prevent panic from spreading throughout the financial world. Fortunately, broader catastrophe was avoided. But the collapse left behind important lessons. The first lesson was that confidence is everything in banking. Banks operate largely on trust. As long as customers believe their money is safe, the system functions smoothly. Once that trust disappears, even large institutions can face enormous pressure. The second lesson involved risk management. Investments that appear safe can become dangerous when economic conditions change unexpectedly. Rising interest rates exposed weaknesses that many had overlooked. The third lesson highlighted the power of technology. Bank runs used to unfold over days or weeks. In today's digital world, they can happen in hours. Information travels instantly, and money can move just as quickly. The collapse of Silicon Valley Bank will be remembered not only because of its size, but because of its speed. It demonstrated how modern finance has evolved and how rapidly confidence can vanish. What began as concerns over investment losses soon became one of the most dramatic banking failures in recent history. For decades, Silicon Valley Bank helped fuel innovation and entrepreneurship. Yet in the end, it became a powerful reminder that even institutions that appear strong can be vulnerable when trust disappears. Its rise was remarkable, its fall was astonishing, and its story remains one of the most shocking bank collapses the world has ever witnessed. If you enjoyed this documentary, don't forget to like, subscribe, and turn on notifications for more fascinating stories from the docuverse. Thanks for watching, and we'll see you in the next episode.